Many times when I'm having conversations with investors and we start discussing global investing, they'll say something like, I only invest in the United States. There's too much uncertainty abroad, so I don't do anything internationally. And that's fine. But what if I told you that just by investing in the S&P 500, you have way more invested internationally than you probably think? In today's video, we are going to talk about why most people are already global investors, and if you are, a more thoughtful way to approach investing around the world. Okay, so let's get started with a few statistics. We're going to look at the Russell 2000, which is smaller companies, the S&P 500, which are larger companies, and see just how much is happening in the United States versus the rest of the world. So this chart here is going to look at the percentage of sales earned in the United States for the Russell 2000, which is 76%, and the percentage of sales earned in the United States for the S&P 500, which is lower, it's 59%. So I'm going to say this in a different way. If 76% is earned in the United States, 24% is earned in the rest of the world. And in the S&P 500, the largest 500 companies in the United States, that means 41% of the revenue earned in those companies happens outside of the United States. And so no matter what, you are tied into the global economy. And if we are going to be involved in the global economy, how can we make more thoughtful decisions on how we can choose to have exposure to the global economy? And we're going to talk about valuations. Now, I've talked about this in prior videos. Valuation is just a fancy way of saying how much are we willing to pay for a dollar in earnings? What price are we willing to pay for these companies given the fundamentals that we see? So let's look at this chart here. This is going to look at the green line is going to be the rest of the world minus the United States. And this blue line is going to be the United States. And if you look at 2010, they both started at the same valuations. Said another way, people are willing to pay about the same price to earnings ratio for the United States as they were the rest of the world. But since then, the rest of the world has stayed about the same valuation. So it's still gone up in value, but people are willing to pay about the same price given the earnings. In other words, it hasn't gotten cheaper or more expensive. While it's gone up in value, its relative value is about the same. Versus the United States, this blue line has ticked up over the last 15 years, where it's now twice as expensive to own a dollar in earnings as it is the rest of the world. And this is an important decision for you to be making, because either way, it's happening, but at least knowing the numbers is that when you buy in the United States, and particularly large companies, as we've seen, about 40% of that is being earned around the world. But you're paying, by buying those companies, this higher multiple up here, okay, up at the top. For 40% of your money that's already being generated elsewhere, you're paying that premium to buy U.S. companies. Well, again, this is not advice, but this is something to think about. Talk with your advisor. If you don't have any direct international exposure, but you have the international exposure anyways and you're paying this U.S. premium, you can get that international exposure at a much lower price to earnings or a much lower ratio directly just by buying directly around the world. Because either way, we are all global investors if we are investors. And if that's going to be the case, we should at least get to choose the price we pay to be that investor. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.